There are moments in markets when everything looks calm on the surface, but underneath something is cracking. Not loudly, not suddenly. Quietly, the kind of quiet that only shows up in shipping delays, shrinking inventories, unusual bank activity, and private reports that never reach the public. And right now, that quiet pressure is building around a metal almost everyone has ignored for years: silver. For the first time in decades, something is happening behind the scenes that even many investors don't fully understand. Manufacturers are quietly warning about delays, banks are withdrawing available metal, industrial users are signing long-term contracts months earlier than usual, and analysts, the ones who actually track physical supply, not paper markets, are saying something they have avoided saying for a long time: the real silver shortage has already begun. But here's the part almost nobody realizes. When silver shortages begin, they don't appear like shortages in food or oil or gasoline. There's no headline, there's no panic, there's no visible disaster. Instead, silver shortages appear slowly at first, and then all at once. And when the price finally reacts, it doesn't creep upward, it breaks out. Tonight we're going to break down why the shortage is real, what's causing it, and what happens when silver's price finally escapes the artificial ceiling holding it down. Stay with me until the end, because the final part of this story, the truth about why the ceiling exists in the first place, is something the public has never been told directly, even though it affects the entire global economy. Let's start with the simplest point. Silver is not acting like a typical commodity anymore. That's because silver is no longer just a precious metal. It has become a foundational industrial material. It sits at the center of nearly every emerging technology that will define the next 20 years. Solar panels, electric vehicles, medical technology, semiconductors, AI hardware, batteries, telecommunications, robotics, aerospace systems. Silver is woven into the technological fabric of the modern world, and unlike other metals, there is no real substitute. Its conductivity, reflectivity, and antimicrobial properties make it virtually irreplaceable in high-efficiency systems. But here's the problem. The world is using silver at a pace the mining industry can't match. Global output from mines has been flat to declining. New deposits are harder to find, costs are rising, and older mines are producing lower-grade ore. This isn't speculation, it's geology. You cannot mine what the earth does not provide. Now contrast that with demand. Solar panel production is hitting record highs every year. EVs are scaling faster than expected. AI data centers require high conductivity materials. Medical systems are expanding. And on top of that, countries upgrading their defense and aerospace programs are consuming huge amounts of silver. This creates the first part of the shortage: pure industrial imbalance. More going out, less coming in, a gap that gets wider each year. But that's only half the story, and not the most important half. The real problem begins when you look at the financial side of the silver market, because the silver market the public sees isn't the real silver market. What most people trade is paper silver: futures contracts, ETFs, digital claims, and financial products that are meant to represent real metal. But here's the truth almost nobody knows unless they work in this industry. The amount of silver traded on paper is many times larger than the amount of silver that actually exists. The financial market built layers of derivatives on top of a physical market that never had enough supply to back it. This system has worked for decades for one simple reason: most people never ask for physical silver. Investors hold paper, institutions roll contracts, traders close positions before delivery. But what happens when industrial users, real companies that need real metal, begin increasing their physical orders? What happens when investors stop trusting paper products and request physical delivery? What happens when refiners can't get enough raw material? What happens when banks can't replace the silver they deliver? Suddenly the illusion disappears. Suddenly the system breaks. And that is exactly where we are heading. Over the past 18 to 24 months, something unusual began happening quietly. Silver inventories in major vaults started falling faster. Banks began limiting large physical withdrawals. Premiums on physical silver rose even when spot prices didn't. Manufacturers began securing multi-year supply contracts. Large institutions shifted from paper silver to physical metal. These are not signs of a stable system. These are signs of a market under pressure, a market preparing for a reset. And if you want to understand how serious this will become, here's the simplest way to see it. When silver shortage reaches the financial layer, price is no longer determined by traders. It's determined by survival. Manufacturers cannot run out of silver. Energy companies cannot run out of silver. Defense industries cannot run out of silver. Medical companies cannot run out of silver. If they have to pay higher prices, they will. If they have to outbid investors, they will. If they have to lock in future supply at any cost, they will. Because without silver, production stops. That brings us to the moment of breakout, the moment most people don't see coming. A breakout doesn't happen because investors suddenly become excited. It happens because the physical market overtakes the financial market. And when that happens, everything changes. A breakout occurs when there is simply not enough metal to satisfy all existing claims, when industrial demand, investor demand, and strategic demand collide at the same time. That collision is what forces the price to revalue. And here's the most important detail. When silver finally breaks out, it won't rise slowly. It will move in a way that reflects years of suppressed pricing, years of underinvestment, years of structural shortages. It will be revalued, not because of hype, but because of reality. And this breakout will have three enormous consequences. The first consequence, industrial repricing. Companies will be forced to adjust their budgets, their production models, and their technology rollouts. Solar companies will face higher costs. EV manufacturers will revise their projections. Semiconductor producers will reprice supply chains. The entire clean energy transition becomes more expensive, but here's the twist. The world cannot slow down technology, so industries will adapt, they will pay more, they will compete harder for available silver, which only pushes the price further. The second consequence, financial stress. Silver ETFs and futures markets will experience pressure they were never designed for. If even a fraction of investors request physical delivery during a period of shortage, the system will be forced into a corner. Paper prices and physical prices will separate. Premiums will rise. Some institutions will tighten redemption rules. Markets will experience volatility that reflects not speculation but scarcity. The third consequence is the one almost nobody talks about, and it is the most important. A silver breakout signals the end of an era where financial markets could ignore physical reality. For decades, the world has placed higher value on financial instruments than on physical resources. Stocks, derivatives, digital assets, and speculative markets have overshadowed the importance of actual materials, the metals, minerals, and resources that make modern life possible. Silver's shortage is the first loud reminder that the physical world still controls everything. Technology cannot function without materials. Energy cannot expand without materials. Defense systems cannot operate without materials. Global growth cannot continue without materials. When silver breaks out, it will not just be a price event, it will be a wake-up call. A signal that the era of cheap essential materials is ending. A signal that the modern economy has reached a new phase. A signal that scarcity, not speculation, will dictate the next decade. So what will the breakout look like? It will look like this. First, industrial users quietly secure every ounce they can. Then refiners raise premiums as raw supply tightens. Then banks begin restricting access to their inventories. Then investors realize physical silver is harder to get. Then spot prices diverge from retail and wholesale premiums. Then futures markets face pressure on delivery contracts. Then the financial world begins to realize something fundamental has shifted. And finally, the breakout becomes visible to the public. At that point, people will say it happened suddenly, but it didn't. It happened slowly, quietly, invisibly, until the day it could no longer be hidden. Because the shortage has already started, the pressure is already building. And the breakout is not a question of if, It is a question of when the world finally catches up to what the data has been saying for years. Silver is not just another commodity. It is the backbone of the technologies shaping the future. It is the metal the world cannot replace. It is the one material whose shortage will expose how fragile the global supply chain truly is. And when the price finally breaks out, the world will understand something it should have realized long ago. The value of silver was never low, only the awareness was.